Hey everyone, my name is Sean Ryan, and I'm your host here at the Predicting Alpha podcast. On today's episode, we are joined by Jay Soloff, ex-SIBO market maker and current head options analyst over at Investors Alley. Jay has spent the last 12 years helping traders get a grasp of the options market and find their way towards profitable trading. So in today's episode, we're going to talk about what it takes to really get started in the options game and the path that you should be heading down if you're trying to make it the distance as a trader. We'll go from where you should get started and where you should aim to end up as an option trader, some of the differences and similarities between the institutional world of trading and the retail world, and some key lessons that you should take away if you're trying to make it the distance as a trader. Through his own experiences and insights, Jay makes the sometimes intimidating world of options trading that much more approachable for new traders. And he has a wealth of knowledge for intermediate and experienced traders to still gain a lot from. So if you enjoy this podcast, make sure to follow Jay on Twitter, subscribe to his newsletter, and subscribe to the Predicting Alpha channel too, so you're always in the loop when new podcasts come out. What does your book look like these days? How do you go about actually structuring it? You know, what sort of assets do you look at? Obviously, vol's a part of your book. You know, in general, what does that picture sort of look like?
You know, and it's a really interesting question because I have two very differentiated viewpoints on it, right? I was a floor market maker and, you know, I was in a world where direction was, you know, we tried to eliminate directional risk as much as possible to basically where we were, you know, only really trading volatility, you know, time decay, gamma, whatever it might be, and eliminating as much directional risk as possible by trading delta neutral. And that experience really taught me about volatility more than anything, but you can't really do that as a retail trader for the most part, right? I mean, the vast majority, right? Like, so if I have, you know, if I get 100 retail traders signing up for some kind of product, there may be 2 or 3 of them that would be willing or able to trade like a delta neutral type of portfolio, right? I mean, the vast majority of people are not going to have the capital, not going to have the time, not going to have the access. I mean, you know, they're not going to want to have a margin account, you know? So, you know, we shifted to what just about every other option newsletter provider does, just to basically long calls and puts to start with, because as much as it's difficult to make money making directional trades, it's also much easier to get started with, hey, I'm going to take $500 and I'm going to play around with buying calls and puts, right? It's something that just about everyone can do. And it's exciting, right? I mean, you know, think of meme stocks, you know, think of how many people were buying, you know, out of the money calls in AMC or GME or something and watching them go from, you know, 50 cents to $5, you know, I mean, granted, really unusual situation and you can't count on it, but it's fun. That caught the attention of like the world there for
100%.
You know, you know, and so it's like, it's one of those things where, I mean, as a professional trader, I don't really want to try to make consistent income from buying calls and puts, but it's by far the best way to start. You know, if you have limited capital and if you've never traded options, you know, it's, and you just have to go into it saying, hey, this is a low probability situation. But if you've never traded options, you know, you're risking $100 a trade to, you know, that's kind of our goal. It's just to keep stuff really reasonably inexpensive and to learn. Like, you know, that's what I tell people. I'm like, we're going to learn as much as we can. We're going to occasionally hit some big winners. It'll be fun, but this is going to be a lower probability situation. It's been hard for me to make that transition as a market maker, where I probably was on the other side of all those trades that I'm recommending, right? You know, I'm like, this is the sort of stuff I like as a market maker, but
this is my lunch. Like,
yeah, exactly. But I mean, it's just like, you know, how do you get started in options with $500? And because that's what a lot of people come to the table with. A lot of people don't come to the table with, you know, with $25,000 getting ready. Now, if they do, then I would get started in covered calls. And again, even though that's a kind of a, you know, a more basic strategy, I've had more success with covered calls than I have with anything else over the last like 4 or 5 years. And and I think that they're underrated as a, so, I mean, you talk about my book, like personally, covered calls are my bread and butter. And that may, and again, that may sound, funny as an ex-market maker, and, cause I worked at a hedge fund. I have, a bunch of friends who are institutional traders. I mean, I could tell you about variant swaps. I could talk to you about all kinds of crazy stuff, but when it comes down to it, I'm cover calls are pretty much what I stick to, because it's like, I think people don't realize that you're basically you're basically getting two premia out there that you're not necessarily getting it. And you, when one sort of trade, you might be able to get one in efficiency or one premium, like the VRP, right? The variance risk premium. And that's the main one that a lot of people are trying to capture with options. But with covered calls, you're getting the equity risk premium because you're buying the stock, and you're getting the variance risk premium because you're selling implied versus real. And it's it's really good, and it's very simple, and you don't need a margin account to do it, and you do need a little more capital, but it's like, that's the sort of stuff that people love. I mean, we get so much interest in our covered call product, in our our classes we have on covered calls get just tons of people who sign up for them, because it's something that people know that works, and it's, relatively easy to approach.
And to be honest, that is one of the things that put you on my radar, was the seminar you did with Yoon about covered calls. And it's actually the approach that I've always taken when talking to people about covered calls as well, which is, it's a nice way to add a variance risk premium element to your book, right? You're already long all this equity, right? If you can identify some sort of like overpriced risk premium on the stocks that you already are happy holding, this is a great way to add that extra point or two onto your annual return, right? Which means a ton in the long run.
Well, what I try to bring back up a little bit, what I try to bring to the table compared to other people in like the option newsletter business is my understanding of volatility, because that's the advantage I had, is being on the floor, but before even, being a market maker, being a clerk and having to set the vol curve for our SPX traders. And so, I mean, just understanding how volatility works is the advantage that I bring. And so I want to use it, and to some extent with the long option service, which is my primary service, it's not as useful. I'm only in the sense of I'm looking for stuff that's cheaper, options that are kind of cheaper, maybe lower volatility than they should be given the situation. I mean, but there's there's a directional component to that. But when we start to get to the covered call stuff, and then because I have some more advanced stuff where we're doing spreads and things like that, and that's where I get into like using vol ETPs, and I think it can be a lot more interesting than to trade vol when you're doing it on market volatility rather than volatility. That's where I think it's extremely useful for retail. Like when we go long volatility or short, which is more likely, I try to do it in a very simple manner using something like VXX, right? So I will do a lot of trades, typically with more of a short, we're talking about long, but long in the sense that I'll buy a put on VXX, right? I mean, because once again, it's like, all right, maybe it makes more sense to sell a call spread on VXX or something like that, but that's not what my people can do. They don't have a margin account.
What do you see as the main constraints for retail around trading like a short vol book?
It's just capital requirements, because you have to have a margin account. And even if you have a margin account, you could do very small size if you're trying to, I mean, how much you need, $3,000 to have a margin account, I think, and at least in the US. I mean, that's, what can you sell with that? How many straddles can you sell with $3,000 margin account?
You're a little constrained with so I definitely understand the capital constraints for sure.
I mean, it's a major, I mean, and this is, I mean, I'm not saying, this is what I'm seeing, right? Like this is my client base, which is a lot of people who have never traded options before. I definitely have more advanced traders, that do have margin accounts that will do, but even so, it's just like, then there's kind of that fear, there's that, that risk level. I mean, that's why when I do, tell people who want to get into more credit type trading, use credit spreads, use iron condors. Like you really don't want to have
like
that
defined risk positions.
Yeah. You don't want to have that you don't want to go to bed with a short straddle, and wake up and, like North Korea bomb someone or something like that. I mean, it's just, it's not worth it. I mean, I had to deal with that stuff as a market maker. I mean, I didn't sleep very well, and so you have these things, and that's why, like, but the thing is that you can still do something like a VXX put and make money on short volatility, but that's only with market vol. Like it's a lot harder again with, trying to do that with, with single stocks. Like without a margin count, it's basically impossible. And you can, but we definitely do a lot of, but it's not just like VXX puts, maybe put butterflies or put spreads. So I'll mix it up, but it's going to be more directional, but with market volatility. So it's kind of like
Well, one of the things that I was watching an interview with you at one of the trade
Money
events.
Or,
like one of the live events. And you talked about in it how what you think is the ideal thing for a retail trader to do with their book is to take positional trades.
Yeah, sure. I mean, I think this probably came after. I don't know if I remember this particular one, but this probably came after reading the book on medallion fund or something, where it's like trying to compete in what would accept, I guess, the day trading or very short term.
Yeah, exactly.
It
was in reference to relative to like HFT and all of this type of stuff. We shouldn't be doing that. We should be taking more like positional trades.
Yeah, exactly. I mean, that's that, and again, that's medallion is not exactly HFT, but I mean, that's kind of it. You're when you're competing against Citadel and you're competing against medallion and Sigma, two Sigma. And I mean, these are the smartest people in the world with the best technology in the world with, microwave connections with nanosecond execution. You can't compete with those people. And even medallion fund makes little over 50% of winners on their trades, and that's enough for them to make 70% a year before fees or whatever it is. But I mean, like you can't, I flat out think, at least with option trading, you can't compete against that. I mean, if I mean, I'm sure there are people out there who do, but it's not a recipe for long-term success. To me, the only way to take advantage of the inefficiencies and the risk premium out there is by position trading, right? And so that could be selling iron condors. It could be using covered calls. And even with long option trading, buying calls and puts. I mean, if I think that there's a strategy out there that's completely legitimate for the long term if you can buy time, right? I mean, if you can kind of replace it with your long equity positions in your portfolio. Now it's more expensive, right? I mean, it's harder to do. But I mean, if you have a bullish position if you have a bullish case on something and you've done your homework and you want to put it on through options, perfectly fine. Now, if you're trying to capture that over the course of a week, it's a lot different than trying to capture that over a year. I mean, I do it in my retirement portfolio all the time. Like instead of buying 100 shares of something or whatever it might be, I'll buy a long-term call or something like that. I mean, why not? Why not take advantage of the leverage? But those are longer term, but that's the sort of thing that, I mean, you're not competing, if I buy a long-term FCX call, I'm not really competing against, medallion in that, right? And they're in and out of trades, and that's the sort of thing that it's just like I mean, even someone like Jim Cramer will talk about this, like position, long, I mean, that he's always beating the drum on, like don't trade stuff, hold it, and position trading, and like it's good advice, I mean, whether it's for entertainment purposes or not, that's good advice that I think people should listen to. I mean, know who your competition is, and and know what the risk premium are.
I think that's one of the biggest things that I really beat the drum on is who is on the other side of your trade, right? If you can't even hypothesize about that, you might be on the wrong side. right? So really, I'm in total agreement with you where, I'm very rarely in a position for less than a day,
Hmm.
right? And it's not necessarily because I like trading a longer time frame or anything. It's because I'm trying to put myself in the best position to win, and I need to be aware of the competition, right?
Right.
And what are the odds that if I'm trying to play a high frequency game and I'm going up against the guy who can execute like that and can see my order flow and and like has all this informational and technological advantages over me, what am I doing? How am I? I'm not really setting myself up for success.
I mean,
Um,
that doesn't include like obviously like if you're doing an earnings play, and I know
oh
and
yeah,
predicting after has all kinds of really cool earnings, like how much it's moved
yeah.
given earnings and how the straddles perform. Now, obviously, that might be a situation where that's a 1 day trade, but
I
that's
hold
a
that
very
overnight though. I don't
well,
I
I
don't
mean
trade it
overnight.
intraday. I hold it overnight.
Yeah, it's going to be at least overnight, generally
Yeah.
speaking, but I mean, and that stuff is event based, and that's a little
Yeah.
bit different, obviously, if you're trading. But even if you look at the research, most of like you look at Ewan's operational
Mhm.
his positional book, option trading book, like he'll say, generally it's like 2 weeks before that you get into that earnings trade.
Yeah.
You buy it ahead of time and then maybe you sell it before earnings and then you sell it, I mean,
Mhm.
like there's different strategies on there that have like long-term success rates, but even that, I mean, it's generally like a week or two,
Yeah.
and for me, covered calls, I mean, generally I use 30 days. Sometimes I'll do like a 2 week cover call if the opportunity, is there. You could do weekly covered calls. I mean, there's nothing wrong with that if you find an instrument that works for that. But I mean, I'm still thinking in terms of weeks, rather than days. Usually I try to think in weeks or months, probably more weeks
Mhm.
than months. When, for trading purposes, because you don't need someone to necessarily tell you to trade something and hold it for 2 years. All right, I'll get back to you in two
Yeah,
years. Let's see
exactly,
how
right?
that did. Right. You don't need
Um,
to, buy a newsletter for that necessarily. So,
yeah, but speaking of positional plays, right, one of the things that I think is so important to consider as a trader is an efficient use of your capital. Obviously, there's a balance where keeping some cash on your book isn't necessarily a bad thing, but when
yeah.
trading positionally, what should traders consider when choosing how to allocate their capital and diversifying across positions, and keeping in mind things like how in a market crash, there's a chance all these.
And that's a great question. So let me think about it for a week and I'll get back to you. um,
Honestly, I probably wouldn't blame it.
then there's a couple,
Yeah, we can
I think
break
there's
that
a
one
couple
down.
different parts, but well, let's talk about like, like Ewan's book where he talks about like Kelly criterion. That's like I don't even know. I mean, that's very powerful stuff that I've never even really taken yet the time to understand, like in terms of position sizing and stuff, just because I probably don't do enough active trading these days just because
Mhm.
I'm busy. I'm busy, doing all the other things that I'm doing. But
Yeah.
stuff like that, obviously, in terms of position sizing. But that's that being said, I think when I'm looking at like an overall like portfolio strategy, um, I've really come to appreciate sort of a component that's a tail risk hedge, right? And I think that if you're going to allocate, more than a few percentage points to any sort of strategy that, particularly that involves like credit, short vol, short options of any, then you need to at least be considering a tail hedge that, and maybe you don't have it on all the time, right? But you probably need to leave some money aside that's out there for whatever. I mean, and how to tail hedge is a completely different subject, but I
I was
mean,
going to follow up with that.
yeah, I mean, like for me, that might be like a back spread, right? Like
Cool.
I like the idea of having a back spread in an index where, there are times you can get something like that for credit, which is really nice, where you're selling like, maybe a 25 delta put and buying two of the 10 delta puts, and you might be able to even get a credit on something like that. That's the sort of trade I don't mind having on in my book pretty much all the time. But
Mhm.
if it's going to be more expensive, even if it's going to cost money, then maybe you put it on when you meet certain conditions, whatever. curve hits backwardation, VIX curve hits backwardation, term structure hits backwardation, or VIX hits a certain level, or whatever metrics you might use, and you're going to be like, okay, I'm going to put on my back spread now. Like I like to have a component that might go towards that, and then you can mess around with other stuff that might be, let's say I'm still a fan, even though I don't do it that much. I'm still a fan of short iron condors. I still really think that for retail investors, if you can kind of find an iron condor strategy, and it's not actually putting it on, it's really the management of iron condors that takes the effort. If you can find a good way to manage iron condors, that's the sort of thing I wouldn't mind having on all the time, and then throwing on, a back spread if things start getting hairy. So instead of having to take off my iron condors, I know that if, the world collapse, or maybe credit spreads, just maybe they're one-sided credit spreads, so that you're not necessarily having the tail risk on both sides. Maybe you're mix and matching credit spreads, but you have that back spread component. I mean, I think that if you can be a lot more free with what you do, if you know that you're not going to wake up tomorrow and be bankrupt, right? I mean, that just kind of frees up a lot of, but in terms of, again, like for me, it's going to be a large allocation of covered calls, then maybe a smaller allocation is some somewhat directional stuff like vertical spreads or out of the money I love out of the money butterflies. I mean, I have a it's an unhealthy obsession with out of the money butterflies, because you're risking so little, and when you hit it, it works out really well. I mean, it's like not hit the center, but you just like, I'll do like wind range out of the money butterflies, and it's it's stuff like that. Like I have a lot of fun with my people, my subscribers love that stuff because they're not risking a lot of money, and so I'll do stuff like that, and as long as you kind of have some sort of, I think, some sort of protection, you're willing to hedge. And the hardest thing for retail clients, I think, to do is hedge, right? They hate losing money on hedges. And that's the problem is that that's the whole point, right?
It's like buying insurance, right? It's like, you pay for it and you hope you never have to use it. But in finance, one day you probably will.
It's the biggest difference between institutional and retail traders, is that institutional people can, in their minds, write off a hedge and not even notice it, and know that, okay, I'm going to knock X% off my return, and that's my protection. Retail has a lot of trouble. I mean, in my experience, across all different products, different companies, different whatever it is, 12 years of working with retail, the hardest thing and the biggest difference is that hedging is such a difficult, concept, not the use of it, but dealing with the fact that you're going to lose money on your hedge most of the time, and they're like, well, why do we have this on?
Why do you think that's such a, challenge in the retail space?
I think it's the way we're trained to look at risk. And me, it's like, economics, finance background, market maker, like, sleepless nights. Like I appreciate it. I don't know if, I think it's just the way I think people maybe, if I had an actuary as a client, they'd probably appreciate it. Right. I think it's just the way we're trained, like I have an MBA. So, there was a lot of risk mitigation. You do a lot of case studies with companies. Well, how do they protect against this? If this product fails or stuff. I mean, I think it's just the way, for me, the way I've been trained, both, the MBA, market makers, I mean, a lot of it is risk mitigation, right? And risk management. And I just, I don't really think that that's a common mindset. And part of it is just, when you're trading, if you're a retail, you're not generally trading full time. You're trading as, along with, either you're retired, you're doing it part-time, you're doing it as a hobby. You don't want to necessarily think about having to hedge, right? I'm doing this, I want to make a few extra bucks on the side. I don't want to worry about hedging. What's my hedge doing? Do I have to move my head? It's like an extra thing to think about. That's why something like a back spread is great, right? Where you're not spending a lot of money, and obviously
roll it every month.
You just roll it every. I mean, obviously, the issue comes into play if you're close to that around expiration, then you have to manage it and stuff like that. But for the most part, like when I was doing back spreads, with as part of like, it was kind of, I think I was doing with Mike Iron Condor we kind of switched to just doing credit. When iron condors weren't doing very well, we started switching to doing credit spreads, and then we were just having our back spreads on at the same time, and that worked. That worked really well. Actually, really the only reason that went away is just because, like I said, it was hard to get people interested in that kind of putting down that kind of capital, having that kind of margin. And I mean, it was, I think, successful in terms of, successful enough in terms of performance. It's just like I found it hard to interest people into doing that.
I 100% will get what you mean. And I'd love to ask you about that sort of transition for traders, because I do think if you're trading options, you should understand volatility. And you don't need to understand it on day one, but it's a volatility product in the end of the day, right? So, if on day one you don't, but you should always be sort of building into this person who's thinking about volatility when trading options, right? Like that would be like the goal to get to, and then it opens up all these other doors for you. But so in predicting alpha, in our entry level education, one of the challenges we had was we tried to introduce people to iron condors, right?
Yeah.
And most of the people who would be joining predicting alpha were intermediate plus level of sophistication for trading, just because a quantitative approach and stuff usually it's something you grow to appreciate, right?
Yeah, absolutely.
But when we would still obviously have some people come in who are even brand new to trading, and I found it challenging to teach these volatility concepts and everything, jumping straight into a delta neutral vol play.
Right.
So how do you sort of see that transition happening? I think it's totally reasonable to start with a long collar put, get your feet wet, right? Like learn this. And then how do you sort of bridge these things, for traders?
Yeah, I know. And that was the thing that we struggled with for a long time. Because we started with the Iron Condor service. So it was like they brought me in. I had experience with newsletters for a different company for quite a while. And that company ended up transitioning to just a content provider, and they got away from the subscription business. So I shifted from them over to Investors Alley, who were really just getting started with the options subscription business. And they're like, well, let's do something high end. Let's get in there. Let's use your, the fact that you're a trader, and let's get a bunch of, let's get a high end service going. And I'm like, how about iron condors? Okay, that sounds great. Right. So we actually started with that and ran into the exact same issue. It was just like, not only was it a more complicated concept, but again, like just all the bells and whistles, it was like, that you need to understand how, let's say, Thinkorswim works and how all these things. And like, cause I recommend if you're gonna do iron condors, you don't want to do it in Vanguard. You want to do it in Thinkorswim or something like that, and so people had to get familiar with the bells and whistles of that. And then it was like, all right, well, how do I get approved for this account? And then how much money do I, and it was this long process. And, again, we were lucky to maybe have 100 active people, which is not, not bad. Like this is a high price service. It's not like, I mean, it's fine. Like, we were doing reasonably well performance wise, but it's just like, I'm never going to grow this thing, right? I'm never going to, from a business standpoint, I'm like, this is a challenging thing. But I'm also like not really going to help that many people either, right? It's like I'm like I have this ability to teach volatility to a large group of people, and and there's 100 really good clients that are learning a lot. But I really want to, I want a wider audience. I think we could do a lot more. And we're like, all right, well, let's start with the basics, right? Calls and puts, like what you said, and so even though we don't use a whole lot of volatility analysis in the actual trades, usually my narrative for making a trade is some kind of qualitative thing. In the background, I'll do a little bit of volatility work, right? I don't talk about it all that much because, I don't want to confuse thousands of people who don't really. So what we do then is have an education section, and that's where I'll introduce like volatility concepts. So I think it's like, it's side by side, right? Ewan does a column in my base product, right? In Option 4 Trader Pro, right? It's calls and puts, right? And that's it. But then after you have a basic call and put, then you have a column from me talking about what the VIX is. And you have a column from Ewan talking about calendar effects, right? So they're getting some really great material, and also some trades. So they have something to do, but they're getting a lot of education. I think, and then we can talk about, all right, well, if you're interested in more, My next level up does vertical spreads. We do butterflies. We mix it in. It's still only debit. You still don't need a margin account, but here you go. You can do a lot more. You need a little bit higher option approval. And then we go all the way to, like cover calls. I don't have, we have some other people. We have some other option, analysts that do, I have one guy that has a service that only does credit spread, so they can go into that if they're interested. So we have some other people doing some higher end products. And I'm still, I like focusing on the education stuff basically.
And I think this might be a part of the gap between retail and institutional is, it's one thing to have the knowledge. It's another thing to be able to communicate the knowledge. Right. It's two very, very different things. And, you find that a lot of the people who are in the world, and this is something I actually really like about Twitter, with the FinTwit and VolTwit spaces.
Yeah.
I feel like it's been a really great bridge between the two worlds that have sort of like allowed people to start thinking differently about trading and understanding what happens sort of on the other side. Because I feel like it's a little bit off topic, but market makers, I feel like there's so many misconceptions about market makers in the retail space. Like, it's like, the market maker's taking my money. It's like, no, the market maker posted the bid and the ask for you to even put the trade on. The market maker's, it's not your enemy, and he's
try making that trade without a market maker present and see what happens. That's
right. Exactly. And I guess this sort of leads into the next thing I wanted to talk about. Really talking about that difference between the retail and institutional worlds. I feel like you're one of the best people to probably ask about this. When you made that transition from, institutional trading to retail education, what were some of the biggest maybe like issues or similarities that stood out to you between the two worlds? And how do you sort of see that evolving over the next 10 years, let's say?
Well, and it's funny because I think that it wasn't intentional, but we talked about one, like the whole risk management and hedging. It's just like, it's such a harder concept to be comfortable with for retail. The idea of, even something like the using a vertical spread, if you want to take a long, bullish directional position on something, doing a call or versus doing a call spread. And, the first, I think, instinct for a retail trader who's new to it is like, oh, I want the call. I want unlimited upside. And I'm like, that's not being realistic. What are the chances that it's going to, what are the chances it's going to go up 100% versus what are the chances it's going to go up, 10%? Lower your risk, and at least risk in terms of capital at risk, by doing a vertical spread, and of course, like as soon as we would do that, it would probably go up 100%. They're like,
exactly,
what are you talking about? but
isn't that how it always goes?
That's how it always goes. But it's like, I think, again, understanding volatility, understanding the importance of volatility was obviously a big, in the institutional world, it was all volatility, right? Being on the floor, it was like, that's all people talked about, right? For the most part, is volatility and managing your vol risk and that sort of thing. And then you get into the retail world, and a lot of it is directional, right? It's a lot of, is this going up? Is this going down? Right? That's and certainly you could do that with options, and I do. That's most of what I'm doing. But it's certainly a different sort of approach, right? That's institutional traders certainly make directional trades, right? But if you look at a lot of the big option-based hedge funds, it's relative volatility, it's it's basis trading and arbitrage opportunities and that sort of thing. They're buying one index volatility and selling another, and making a small amount and a large amount of relatively safe. That's sort of, it's more of an absolute return type stuff. And so there's a big difference there. And there's also I think a big something that I might disagree with some of my peers who are in the institutional spaces. I actually think there should be ETFs for everything, or ETPs or whatever. I think that retail should have access to correlation trading and should have access, there should be, there should be a, within reasonable, obviously within reasonable, I'm not sure
access to different risk premiums, things like
yeah,
that.
exactly. I'm not sure that retail needs access to variant swaps, but like there, there's discussion of having a CDX, a credit default swap, like the CDX index, like having more access to that through ETFs. There used to be some stuff that went away, and there's some groups trying to bring that back. I think all that stuff should be, I think any sort of major strategy that institutions can make money on, for the most part, should be available to retail. I believe that as someone who has seen the benefits that institutions have over retail, and I want to narrow that gap. Now, there are plenty of people who disagree with me because of what happened with XIV, right? People don't understand the products. They get run over. It happens all the time. And so it's like, yes, there needs to be an educational component. Like I've worked in the structured product space, and more recently, just kind of, on the side, just, doing some writing and some research. And it's like, it's the same sort of thing. It's like structured products. They can be a great thing for financial advisors to put their clients in, but they could also be completely misunderstood, and they can have really high fees. And it's like, that's the sort of thing like where there's benefits and there's huge benefits, but misused, it could be a disaster, right? So
that's where I'm a little bit torn myself, right? Because there has to be some burden of responsibility on the investor as well to understand the products they're trading, right?
Yeah.
Like one I think of that sort of had its own debacle was USO. So the oil
negative
futures,
oil,
yeah, right. And people aren't understanding that this product holds the futures,
right,
and that it's rolling down. So even though you think you're buying negative value oil here, you're really buying something that's rolling down into that negative value, and a ton of people lost their lost a lot of money on this.
Yes.
Right. And then a few people who understood what was happening made a ton of money.
Right.
And, it's a weird one because that product is a good product.
Yeah.
Right. It's a nice product to have available on the market, but it creates these potential pitfalls for new investors or with this whole rise of, this online community of option and trading communities, right, where we're talking millions and millions of people collaborating online together. You can easily have these situations that even could be, concocted intentionally to that these products could be really bad for people.
Right.
So it's a very weird middle ground. I'm not sure how it'll play out.
I absolutely. It's tough. And I mean, you could say the same thing, with VXX and the futures role and stuff like that. And we try to take advantage of that. That's one, a primary strategy I like to use. But I mean, it's like, I completely agree. But that's the thing. It's like, you could say, okay, well, look at all the people, the SEC doesn't want to approve a short volatility product because look what happened with XIV. But then you could say, hey, what about people in AMC that got, what if you're short AMC? So are you gonna not approve, the stocks that have high short interest?
Exactly.
It's like ultimately people can get run over anywhere, or they can make money anywhere, and there is a burden on investors to do some research. But I mean, you can compare it again to like the subprime crisis, right? I mean, there are some people who made a lot of ill-advised home purchases. And then there's a lot of people, there are a lot of like whatever mortgage businesses out there, convincing people that they can't lose money on this because real estate only goes up. Who's at fault there? And I tend to think that to me, it was more of the institutions. Yes, there are certainly people. You shouldn't be an elementary school teacher making 30,000 with 5 homes. That should be common sense. But if you're an elementary school teacher that has been told that you can buy a $500,000 home because prices only go up when you can only afford a $200,000 home, to me, that's the mortgage broker. And that's what I'm saying. So ETF companies need to be out there saying, all right, here's our risks. And the SEC is pretty good about this. Like, you can't make a bunch of promises with ETFs, right? I mean, you have to be pretty sort of that, this is what we do here. This is the risks. I mean, I think as long as that stuff is out there, And then it's up to the investor to make sure that, I mean, with XIV, it was a little bit tough because you really had to dig into the prospectus to say, all right, well, we have to roll X amount of futures after close
Yeah.
based. I mean, that was kind of a poorly designed thing that
Yes.
hadn't really had an issue up until that point. Right. So, there's going to be stuff that is a first time for everything, but
Yeah. And you could maybe, a simple enough workaround maybe is similar to how TD Ameritrade and all these companies allow option approvals. You have different levels.
yeah,
And you have to qualify more or less, right? You can qualify based on signing off on a degree of experience or by
right.
passing certain tests, right? Which demonstrate that you understand this product, right? And that way, if you go sell a 0 DTE Delta 10 strangle and the stock moves and S&P drops 7% or 8%, you knew what you were getting yourself into, right?
Right. Yeah, no, absolutely. I mean, I think the main thing is that it shouldn't necessarily be. I'm not a big fan of the whole qualified accredited investor thing where you have to have X millions to be able to invest in certain things. I understand why, but
Yeah.
I feel like what you're saying is a better way to do it. Like have people, pass some kind of knowledge check or some kind of risk waiver or something like that, or because it's
Exactly.
like because you're keeping some really good stuff from people who I mean, you might be you might just be in a career that is not a high paying career, but you're perfectly capable of understanding how hedge funds work, right? But you've because your career choice and you've chosen to be X, Y, or Z or
Yeah.
whatever, and you're never going to be an accredited investor. But hey, I could get a lot of advantage from having $50,000 in said hedge fund or something like So I mean, but again, it's like I totally I understand why the system is in place, but
Yeah.
and also changing anything like that is always like
It's a nightmare. I
a
couldn't imagine.
nightmare, right?
I assume it's a nightmare and it's probably worse than that.
Yeah.
So I wanted to ask you about one more thing here, and then we'll end it off with a little fun thing. I wanted to ask you if you had any cool trading stories or a crazy trade that you wanted to share with our listeners. But before we do that, one thing that we haven't talked about, which I really want to ask you about, I feel like you have a good pulse on the retail trading space. This huge influx of retail traders in the last year, courtesy of Robinhood, pandemic, meme stocks.
Yeah.
How do you see this changing the landscape of trading and any opportunities that might come out of this for how this is going to impact the game of trading, right? It's obviously, I saw a post. It was like retail option volume went from like 5% to 20%
Yeah.
of the total contracts traded, like so some absurd number. This has to have impact on the game.
Yeah.
What do you think is going to happen because of it?
I mean, I don't know if it's going to be long term, but I certainly think it's impacting skew, and not I mean skew in the sense of both put skew and call skew, right? Steeper skew on both sides. I think that what it used to be, so like brief history, right? Like after the crash of '87, you started seeing a lot more put skew, right? Because that never happened, right? We didn't have that kind of crazy crash like it with when options were really tradable, right? And then you have but it quickly recovered. And then you had 2008, 2009 where tail risk really became a thing because that wasn't just that was a multi-year thing that wiped out a lot of people. So then you have certainly tail risk becoming this thing. Well, and I think what COVID and recent times is that now it's like you already have the put skew. Now let's add in this call skew because now stocks can soar 100% higher on a dime because of gamma squeezes and all the stuff going on that happened with GME and AMC and something. So now I think you have this world where you have like steeper skew, particularly in single stocks. So single stocks were dead, I think, for a while in terms of like, I mean, there was volume there, but I mean, it's just like I think a lot of market makers and are making their money on single stocks now, and maybe they weren't for a while, right? And or institutions or whatever, and it's like I think that you're gonna see these steeper term structure or these steeper skew smiles basically in single stocks, and to some extent maybe index.
You think it's mainly like institutions on the put side hedging positions, and then retail on the call side buying out of the money calls, looking for this move?
It could be that, or, I mean, it could be, it could be people buying. It could be plenty of put buying just because of the bounce back on some of these gamma squeezes too.
Mm-hmm.
I mean, it could be, I mean, there's just like, I think the whole convexity thing has really gotten to be important. And it's also like become like a popular, you look on Twitter,
Yeah.
like a couple of years ago, you never saw the word convexity. Now you see it all the time. Right. And so it's like, you just have a lot more people, buying wings, buying skew, buying gamma, whatever it is, and,
Yeah.
and, is that, is it a phase? Probably, but it could go, I mean, this could be something that goes for a while, as long as people are still interested in option trading. And 100%, like, my business has grown by a ton since the pandemic. So, I mean, certainly there are people that are really interested in option trading, and I don't necessarily expect that to go away because the access is there and it wasn't before. Things like Robinhood have really made it easier, and the popularity of things like Thinkorswim and all that for people to actually do some decent analysis for free. Like you get that for free if you're a TD client, so I mean, that stuff is out there. So but I mean, also things like covered calls, and put underwriting. So you could also, you could see that maybe come back down, as well. So it's an interesting question. It'll be really interesting to see how it evolves.
Yeah, I am not sure either, to be honest. It's unprecedented, right? There's nothing we can look back at and say, oh, well, it happened here, and maybe like a ton of retail got involved in .com, but that was completely different. This is like on a scale that's like never before seen. It's completely changed the dynamics of the market.
Well, yeah, and they in .com, and I was on the floor for the .com stuff. They didn't have the options access, right?
Yeah,
like a lot of people didn't trade options, and if you did, it was expensive, like higher commissions. You didn't have, really the concept of a gamma squeeze probably didn't exist there. I mean, unless it was purely institutional, right? I mean, they're just most of the people who were playing .com were playing in the stock realm, right? Most of the retail. So this is very different than that in that sense. I mean, it's got a similar feel to it, but just the dynamics are very different because of the option involvement that we didn't have in the back then.
Let's end it off with a story. Let's hear a good one. You got crazy trade, best trade. What do you got? Let's hear something.
Well, it's funny. I mean, I think some of the more amusing stuff is kind of like what I had to do as a clerk, like, and now how things are now. Like when I was a clerk in the late 90s on the floor, at that point, all of our traders were in the SPX pit, the S&P 500, and that was the biggest one, and still a pit. It still actually exists as a pit down there. That was where the most action was. And so there were only a few companies down there that actually had screens, right? Like Blair Hole and, Wolverine and Timber Hill. And you had a few of these bigger companies that actually had like handheld screens, right? Most people had sheets. They actually had physical sheets with prices at different levels, and they flip through this, and they'd have all the option prices for everything, these huge sheets, and so during it was 98, I think, a long-term capital management situation, right? Like things went nuts, and I was supposed to be training like the guy that was going to become the next head clerk to take my spot when I got on a seat. And like, I couldn't talk to him for a week and he was so mad because it was so busy. And so what I'd have to do is, well, also the other thing is that the SPX, like you would hedge it. The options were 100 delta, right? But you would hedge with the futures on the CME, which were 250 delta. So it's like there wasn't an exact hedge for the options. So we print out these risk reports from the software called MicroHedge that would have like the total delta positions for these different, and it's like I would bring a risk report to the pit and it would be completely useless by the time I got it there. Meanwhile, the sheets would be but to create new sheets, like I'd have to go out of the building up to the office, and back then we would hand I did my vol curve I would set was in Excel. I would go and find like points of things we're trading and then smooth the curve like by typing in all the numbers in Excel and then printing out new sheets. And so during like capital management situation, I'd have to run up there, print new sheets, run back down. By the time I got them to the pit, they'd be useless. Run back, print new sheets. Meanwhile, run back and print new risk reports to show where delta was. And it was like, now it's like, boom, you have a screen and I mean, after a while, like the pits, even before they went away, all this stuff was just done for you on your little hand. This was, again, this was pre-tablets. Like the first tablets were clunky things that only like the Blair Holes that, got bought out by Goldman Sachs, right? They're the ones who could afford that stuff, right? Small trader, most of, market makers, locals were smaller groups. And, and it was like crazy with these sheets and these tickets you're writing stuff on and things flying everywhere. And I'm like, and I just remember trying to train this head clerk who was so mad. He's like, you haven't told me anything. And I'm like, I just try and just, I'm just trying to stay above water. It was, it was hilarious, and you'd go back and it'd be like pandemic, screaming and things flying and, traders throwing the sheets at you. These are useless.
It reminds me of like a scene out of like Rogue Trader or something, just like, that's unbelievable.
It was, it was a lot. It was a lot of fun. In some ways being a clerk was more fun as a trader because you didn't have the risk. Like it wasn't, I need to make X amount, or I'm not even going to pay for my seat lease, or, the interest on my long stock or whatever, like as a clerk, it was just like, get it done, anyways, that was, there are parts about the floor that it's kind of sad that it doesn't really exist, but certainly a lot more efficient with now, 100% with the way markets are now, a lot more efficient.
Oh yeah, for sure. Oh, like that's so funny that there was a point in time where some firms had the technology to have like a stream of data, and other firms were still relying on pen and paper. Like that's not fair.
Yeah. Although spreads
difference.
were such that everyone can make money back then, right? Back in the day when you can make 50 cents edge on a trade as a small trader, then you didn't have to do that much to justify, what killed the smaller trader was, the fact that things are penny wide, like the really liquid stuff is 5 cents wide and you have to do the volume to make up for it, and, unfortunately it killed the small market maker, but, again, you wouldn't have AMC 10 cents wide on a 400% vol day if you had small traders running the show. So, it's definitely more efficient.
Yeah. That's pretty crazy. Like, to think about what somebody must have access to have the confidence to put a 10-cent spread on at the money AMC vol.
Yeah.
In the middle of it rocketing 100%.
Yeah, it really makes you
that's
think,
weird.
Right? Yeah. It does for sure. Like these people really trust their models, and that's
Yeah, that's what I hope they got paid for doing that. Like if you have the courage to do something like that, I hope you made a bit of money.
Yes. And I'm sure they did.
Yeah, exactly. Right. Well, Jay, it was a pleasure, man. Thanks so much for coming on.
Thanks, Sean.
And I'm going to drop a link to Investors Alley. And if there's anything else you want me to drop down there as well, I'll leave it in the description for our listeners to check out.
Perfect.
All right. Thanks a lot.
Thanks, Sean.